2, 1, and we're live. It's Option Edge coming at you on a Friday afternoon. Market just closed about 45 minutes ago. We're reviewing my elastic trade that I put on a couple weeks back. We put this on May 7th. We paid $590. We're currently up 26% with a 155 total gain, total return. So I looked at the chart. So we bought around this area here. You can see this was the trigger. The signal was a Bollinger Band recovery trigger where we dip below the Bollinger Band, then come back up through it. And as you can see, it's been a good trigger. Took a little time to develop, but we're well on our way to having a nice profitable trade there. So what I did today with growth stocks up. And this market still being not like it was just a few months ago. If you remember, January, February, these growth stocks just kept going up and up and up. But that's sort of not happening now. So anytime I get some sort of gain like we did here, so I instead of just selling, that's the wrong one. Instead of just selling this for my gain, for a gain, I want to sort of let it run. But I want to take some risk off the table. So what I did is I went ahead and sold a call spread, a call credit spread against this trade, okay? So I went out. Let's look at the chart here. So this blue line here is the 200-day moving average. And I'm looking at, besides that, also some resistance levels. Like right here looks like some heavy resistance around 120. So the 120 area and the 123 is where the 200-day simple moving average lies. So I decided to sell credit spread directly above it, give us a little cushion. And the idea is even if this trade goes up, or even if this trade goes down, and today I put this trade on, and you can see I'm up already 25% with that. So it's a way of after having a little bit of a run, when you have a little bit of a run in the market, you want to sort of hedge against the run, expect some sort of reversion to the mean coming back, and that's what we did, and it sort of worked out. If I hadn't put this trade on, I would be, wouldn't have this type of gain. So let's visualize this. Let me show you. Let's start first. Let us start first. This is what this trade looks like. Okay, so the problem is with this trade is if it goes beyond the, once it starts going above the 125 level, that's when we can get in big trouble here. Max loss is about $1,200, but the thing is we already have that other trade on, so that's sort of protecting us. So let's look at what this trade looks like in total. So we're selling, the original trade I put on was the 105. We bought the $105 call and sold the $120 call with the expiration of June 18th. This is what it looks like right now, but you got to remember we're already up. We already have a gain, that $155 gains, the upside that we achieved, and then today we put on the trade, and now that has about a $75 gain to the bottom. So if this stock comes in below, if it keeps moving up but comes in below the 200-day moving average, right around the 123, from 120 to 123, if it sits there, that's our max profit of $980. Okay, so let's go back to TradingView. So yeah, right around that 120 mark, even if I see us landing somewhere come, this is May 26th, trying to go out a little bit here, June 18th. June 18th is all the way out here. Yeah, I could see ourselves being right around this area. We could make a little bit move to the downside. If I ever wanted to close out one of these, I could close out this, if we make a move to the downside, I can close this trade out and then leave on my my original trade or something like that. So there's a lot of different things you can do. So like I said before, it's with this, it's one way to when you're up in a trade, like I said, I'm up 26% already. By selling against yourself, it's sort of de-risking your position and hedging your position, and that's what I'm doing. So hope you guys like this. Please subscribe and give me a follow. Peace out.